When you talk to your clients, what's their question about Brexit? What do they say?
Well, clients are very concerned not only about Brexit and the implications, but also about what's happening with the U.S.-China trade tensions. I mean, that is front and center of every single conversation that we're having with clients. But there are two important takeaways. Number one, you got to stay invested. And number two, think about risk management in those portfolios. So the markets have rallied 20% since the December lows. And this year's growth expectations are much lower than last year's. So how are we going to continue to help clients manage risk in portfolios? One of the ways is through diversification. So I'm not just talking about asset class diversification, but I'm talking about geographic diversification. So we've seen time and time again that investors tend to have a home bias in their equity positions in their portfolios. So one way to protect against that is to add international equities, emerging market equities, build a global portfolio, because time and time again, global equities outperform single country equities in downturns and difficult situations.
For a U.S. investor, where's the biggest bias? That is to say, where's the biggest blind spot? I mean, we talk a lot about China. I would assume most people think, yeah, we know China's. Is it India? Is it Indonesia? Where are the things that people are just not paying any attention to, and they should be?
It's interesting that you say that people think about China. The truth is, China represents such a small portion of U.S. investors' portfolios today. There is a very large home bias in the U.S. Investors' portfolios. So adding on selectively into international markets, including China, is very healthy and important.
So what does that mean, though, longer term for protectionism in general? I mean, you mentioned India, right? We've seen Prime Minister Modi sort of coming out and supporting local businesses and making it harder for Walmart and Amazon to operate there. So how do you make the distinction between you want to diversify and also protectionism may not be going anywhere anytime soon?
Well, you know, as we look at market downturns in the past decade, global portfolios have always outperformed single country. So we definitely want to be as diversified as possible in both the asset classes and the geographical concentrations for our clients. And for example, in the emerging markets, we're very specific about opportunities that we like. For example, in China, where obviously there's a lot of fiscal stimulus, we've seen the loans shoot up to record levels in January. You still have very high savings rates, 40% saving rates in China. You have a huge emerging middle class. It's going to be a consumption story in China. So I'm just sticking with China for one moment because there's also so much innovation that's happening there. But it's important to have local expertise, people that know how to invest, know the companies, know the management teams extraordinarily well.
So as we try to go over this myopia, if I can call it that people have, they only look around immediately around them. How do you take into account things like the depth of the capital markets? I mean, how much liquidity is there to begin with? Yep. Rule of law, reliability of the numbers that we know them. How do you take the right discount? Because it may be a big market, may be growing, may be doing well, but there may be other things that hold you back for good reason.
Well, that's exactly why we have our local teams on the ground that know the companies extraordinarily well, and that's where we're different. You know, we've got investment teams based around the world in each of the geographies to help make those assessments. They know the management teams, they know the companies extraordinarily well on the ground. They understand the environment, they understand the political situations, and they help navigate custom client portfolios for clients.
So the other thing we've been talking about over the last couple weeks, especially when it comes to International Women's Day, was the rise of spending for women. Basically, yes, we're going to outlive men, and we're going to wind up making a lot more money at the end of the day. So that we're going to have to invest it, and that's going to have a huge investor pool. Are you noticing that trend start to pick up, and what does that tell you about where that money is going to go?
Absolutely. So global growth.
No offense, David, by the way.
I know. I'm not going to live as long as you are. No question about that.
So global growth has grown 5% in the last year, 320 trillion global growth. A third of that is here in the U.S. We're the #1 region. However, interestingly, women currently control 40% of global wealth and are expected to control 30 trillion more over the next decade. So what's interesting is, in addition to everything that we do, the core for the female clients, the asset allocation, banking, lending, and wealth advisory, we've also noticed that female clients are very much focused on socially responsible investing, impact investing, making a difference. So I had a discussion with one of our female clients earlier this week, and she was saying, I want to invest in diverse companies. So the ability to really build out a portfolio for her that focuses on that. I've had other conversations where clients are very much focused on environmentally friendly green investments as well. This is becoming so much more of a mindset. It's not an asset class, it's really about a feel-good way to invest.
And how do you balance making money with those other values? That is to say, we want to do both at the same time. Do you necessarily have to give up some of the return, some of the yield, as it were, in order to have diversity and environmentally responsible companies?
No, in fact, you could make a better return because one would argue diversity equates to outperformance, as do many of the other governance factors we've talked about.
And going forward, when you talk to your clients, what's the biggest risk that they see? What are they most nervous about in the medium term?
Yeah. So everyone in the world is wondering what's going to happen with the U.S.-China trade discussions next month. I mean, that is top of mind. If we reach a resolution there, I think we could see a nice sort of relief rally in the market. I think a lot of the increase so far this year, 12% up year to date, has in part been due to the fact that there's an increased sort of optimism around those trade discussions coming to a good resolution. But I think it is important to note that we've had a 10-year bull market and growth is slowing. So how can you think about taking some of the risk off the table? Mm-hmm. Is it hedging? Is it buying insurance? Is it locking in some of the gains? Those are all the discussions that we're having at the moment with our clients.